Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Casey Stratton. He's a seasoned real estate investor with over a decade of experience and has been a general partner on over $200 million in deals. Casey was first introduced to real estate investing while seeking to build alternative income streams after being laid off from his tech job during the Great Recession. This experience motivated him to explore more alternative ways to generate passive income and grow his net worth, avoiding dependence on a W-2 job. Today, Casey focuses on bringing passive real estate investment opportunities to hiring professionals looking to build equity and passive cash flow. So, Casey, thank you so much for being on the show today.
Hey, thanks for having me.
So before getting into real estate, can you give us a little bit about your background, both a little bit professionally and also personally?
Absolutely. So my journey really started, I studied material science in undergrad and at the behest of my dad. And during that, I realized I didn't want to be in a lab all day doing experiments or, looking at CAD models. So I decided to get my MBA in finance pretty early on and went to University of Washington. And during that time, I'd always loved understanding how money worked just as a hobby, but I started really getting into investment theory. And that's kind of the start of my journey into the investment realm. Like you said in the intro, I graduated and started working in telecom. And this was in the wake of the Great Recession. And unfortunately got downsized. And, over in Seattle at that time, unemployment was high, and it took 6 months for me to land on my feet. Again, back at telecom, I was in corporate finance at T-Mobile. But that experience had really jaded me. I thought that, there's a bit more loyalty with employers, and if you worked hard for them, you'd be taken care of. And so it kind of just woke me up about, I really want to be in control of my own financial destiny here. And I was doing a little bit of research and came across the FIRE movement. I don't know if you've heard about that, but it's the financially independent, retired early. And having that stability really appealed to me in a way that my wife and I started buckling down, saving a lot. And we did, maxed out the 401k, index funds. And during my research and with my finance background, I came across real estate, which I didn't know anybody in my life who'd ever done real estate investing. And so it's pretty foreign to me, but I was running some of the numbers, looking at the benefits from cash flow appreciation and tax, and, convinced my wife that we should sell our house and buy a couple duplexes and live at one side of them. So we did that in 2015, and over time just got into bigger and bigger assets and started bringing in friends and family. And, now we're just raising capital and doing acquisitions.
After going from that house hack into other properties, were they like small multifamily, like duplexes, quads, triplexes, or were you going into like almost smaller commercial family type properties?
So after the duplexes, got out of multifamily for a bit, actually. During that time, my wife and I had moved back. So we moved out of Seattle to Eastern Washington, where we grew up. We're in the Tri-Cities market. And I reconnected with some college buddies who had started buying, they had one dilapidated commercial property in our downtown districts. And they were more mission-driven investment of, we want to revitalize our downtown. And I thought that sounded really cool. So I jumped in, wrote a $50,000 check with them. And we thought we were going to be remodeling this building. But it was built in during World War II. The footings were not up to code now. So no engineer would sign off on what we wanted to do. So then we accidentally got into development. And that was my first development project. And then we continued to grow, buy more retail and office buildings. And, it took me probably 6 years to get back into larger multifamily. So that was, right around 2019, 2020.
Yeah, development is a whole, people try to lump it together with multifamily investing, but I feel it's like it's a whole different beast. It's a whole different animal of what you're working on. I mean, there's so many different variables that are going with it. And I think people kind of gloss over the amount of risk you have. I mean, there's a lot of risk in taking on short-term debt, financing something that if it's 0% or 99%, it still's not worth anything per se. You know what I mean? Because it's not generating any cash flow.
It's a whole different beast. I will say, I think it was one of the most exciting professional or investment experiences watching this tractor come in with this big claw and start chomping away at the existing building. It was I had my son there who was 4 at the time, and he was just, what are you doing? So there's a lot of fun excitement around it too. But I think that whether you're looking at value add or development, you really got to understand the different risk return profiles of that.
Yeah. And I just, one of the things that kind of made me cringe a bit during when we went through this last few years, which we're still going through it, and you had a lot of operators that weren't able to make numbers work anymore on, on value add deals, and they were pushing development without having any experience and successfully raising money for it. And it's just, it's a whole different thing. People don't really have, you got to work with someone that has experience in what you're investing into. And it's kind of difficult where they know how to deal with it after it's built, but like we got 3 years until it's built.
I think it's very healthy for investors and operators to understand where their blind spots are and to try and find partnerships that can fill that in. I mean, it's funny you mentioned that, because we're actually working on 2 development projects right now. And yes, I've done commercial development once, but I don't consider myself the expert in that, where I wouldn't want to go without a partner. So we're partnering with a general contractor here who has done lots of development projects and has generally used his own money to do them. And we're looking at bringing in additional capital to increase liquidity and that. So I think that's a pretty good way to approach development.
Yeah, you really minimize your downside risk when you're bringing on experienced partners like that. Before you're getting into larger multifamily, one thing that I would hear, online, and they would always talk about with multifamily, especially smaller multifamily properties, like the 1% rule. And I never got this to really pencil for myself with deals I really want to buy. I mean, when you were doing it, how was that? Because now it's not really a 1% rule anymore if you're buying properties outside of war zones, as I see it. You know what I mean? But how did you see it when you're starting, and if that information was disseminated onto you as well?
Well, yeah. I mean, when I was starting, they were talking about the 2% rule. And so that, I mean, I bought the duplexes in 2014, and we were able to, pretty much hit that 1%. And I was so cautious on those first deals. I mean, I didn't know how good it was to have. I mean, we were looking at positive leverage of like 300 basis points. So our cap rate coming in without any improvements was 3% higher than our cost of capital. We're looking at 7-8 caps on, these small properties on, I think, 4.25 debt. So it was pretty easy. I mean, I didn't know how to underwrite very well at that time. I was kind of, bigger pockets, reading some books, but I had low confidence in my pro forma number, right? And so having that safety in there at 1% was very beneficial. You can't find that now. You got to value add into the 1%.
Yeah. And I'm always a little cautious if I see people talk about that. I mean, referencing it, obviously it's a rule of thumb that you can utilize, like a lot of different tools we have of filtering out deals to some extent. But the thing though is that I think you also, it doesn't take into any consideration about like where that property is located, because you can probably find those still, but like, do you really want to be buying? I mean, we're looking for, as I say, like a mix of cash flow and appreciation in our deals. And maybe you're going to get cash flow. Are you really going to get appreciation? And do you really want to, how are you going to manage those properties if they're in those areas that aren't as desirable, let's just say?
We've been fortunate in avoiding any war zones. I've had friends who had great cap rates, or 1.3% going in, and the theft of copper in the walls and high vacancy and headaches. It's just, I don't know, not something I'd ever want to go after.
Yeah, my dad was a D-class investor when I grew up, and it was a mess. I mean, it was something I would never want to do, and then he just kind of put upon me to buy better properties. So I started with like C-class properties, but it was something that, and it is it takes a quite, that's why you can't really find property management companies that has to self-manage it, because no management company in their right mind would take on a property in that class. So very, very difficult.
We have a mantra that guides our investment. If I wouldn't want to live there with my wife during college, we're not going to buy it. So when we look at a property, we walk it, look at the curb appeal, look at the vehicles around there, look at the surrounding properties, obviously look at crime reports, but then also, if we go tour it on a Tuesday morning during the work week, how many people are at home versus at their jobs? all these things kind of factor in. So, you can get a feel for, is this a B or a C, or, but it's if you're not comfortable there, then your intuition's telling you something.
Yeah, I think like Tuesday morning, but also like Tuesday night, or also, 10 o'clock, 11 o'clock at night, seeing what kind of activities there. And then we did that really specifically on our first syndication deal a few years back in Tampa. And just like, it was like really quiet and we were lucky, you know what I mean? But like, these are things that you start looking at when you don't really know the neighborhood as well. Since, real estate is a hyper local type investment, and it can change by blocks, and everybody's been doing that drive before when you're like, whoa, what just happened here over there? You know what I mean?
Yep.
So you talked about partnering with doing some development deals, but like when you're getting started in syndication, and obviously most people get started in syndication, the scale and to, they run out their own money, which is kind of what happened with me. And I imagine what happened with you, but how did partnering with more experienced syndicators kind of accelerate your syndication business?
Our business is a funny one in that so much of it is relationship based. And you look at the number of partners you need to get a deal done. Obviously, you need brokers that you can work with and trust to bring you good deals. You need access to lenders or a debt broker, insurance, property management. All of that is relationship based. And being able to leverage someone else's experience and relationships really starts helping you get to know who you want to work with. And deal flow is probably one of the more important things out there, where you look at the motivations of the brokers. They want to work with someone that they have a high confidence that can pull off the deal, right? That means they can bring in the equity to close. That means that they have a balance sheet and experience that the banks are going to lend on. They know how to underwrite and navigate the thorny issues that are inevitably going to come up. We've never had an acquisition that we haven't uncovered something where we had to have a lot of hard conversations with the brokers and sellers. How do we remedy this where everyone can work with it and pursue, keep working through the deal? And that takes a lot of trust with the brokers. And then when they have that trust and that track record, they bring you the first look at deals, and you're able to either do off market or, not have a lot of competition at the bidding line.
Yeah, that makes sense, because obviously they have a legal representation of the property that they're bringing to you, and they want to make sure that that they're acting in that seller's best interest of finding someone that's actually going to close. And they get paid on that too, but it's also they keep their names on it, and if they're going to build their business, they have to make sure that the people they're connecting are actually going to do business and actually close. So it's definitely a very important thing, especially as larger you get into multifamily properties.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So Casey, kind of talking about what you guys are doing now. What is your firm's current investment strategy and investment criteria, deals you're looking at?
Well, I think like most other GPs in the industry, we saw a slowdown with the interest rate hike. I was pretty fortunate that I had exited my previous fund in 2023, and so we were starting fresh with new assets in the new environment. And so we did not have much of a cap rate expansion hangover like I know a lot of people were working on. That also, there's been a lot of operators who need to recapitalize or save legacy projects that were required in before 2022. So we've been fortunate in that, but with the interest rate hike, we're just now seeing cap rates start to catch up where you're going to have neutral or maybe slightly positive leverage. And those are generally only happening on value add deals. So our acquisitions have been a bit slower in the past year, but we're seeing things wake up. And right now we got a a value add deal in Tri-Cities that we're working on closing on this calendar year. And we believe that multifamily development has a very strong investment thesis here. So that's why we're looking to start bringing that to our investor base.
What are some of the market drivers your company focuses on before venturing into a new market or choosing to? I mean, developments. I mean, if you're buying anything, I mean, obviously there's 5-7 years that you're holding this asset for, most likely in this type of market. But development, I mean, it might go even longer than that possibly if you're going to refinance and hold the property because you have to develop it. So what are you really looking for in a market that's going to make your firm decide to invest there?
Mm-hmm. On the development side, on value add, we're looking at a number of markets in Eastern Washington, Spokane and Tri-Cities. We own in Pullman, Washington, which is home of WSU, Go Cougs. And we'll do value add in all those markets because they have the right fundamentals for us. But in terms of dipping our toes into development, we're only looking at Tri-Cities market for a number of reasons. One is we have our GC partner that we know, like, and trust and has a great track record. Two, the macro outlook on demographics and job creation are quite excellent in Tri-Cities, where we joke that it's the fastest growing MSA that no one's ever heard of. And what's driving that is we have a unique combination of, well, let me back up. So if you haven't heard Tri-Cities, we were actually one of the one of the cities that built the plutonium for the Manhattan Project back in World War II. And so that drew in a large population with a lot of education. And then with that, the Pacific Northwest National Lab was started in Tri-Cities back in the 60s. And so we have a lot of human capital. We have really the Pacific Northwest only nuclear power plant that operates. So we have cheap nuclear and hydroelectric power. And we have the Columbia River, which is a huge shipping asset, as well as rail and interstate intersections. So when you look at, we have a lot of factors that are extremely attractive to national employers. And we just we're I think about 320,000 population currently. So once you cross that 300,000 population mark, you reach a new threshold of size where national employers look at locating their operations. So that's created a boom. And with the data centers and warehousing, abundant power and reasonably priced land, we're seeing tech move in here as well. And so all of these are driving the right amount of job creation where development becomes very attractive for us. So in a nutshell, we're developing our own backyard. We can keep close eyes on it, and we have a partner there that we trust and strong outlook on economic growth.
How do you guys effectively navigate the regulatory guidelines and for properties when investing in like a tenant-friendly state? Myself coming from Connecticut, you being in Washington State, if I understand that there's some sort of, you guys have rent increase caps there, which might not affect you in all parts of the market, but at some parts, I mean, it's one more thing that you have to abide by when running your business.
It's been interesting. We've had a lot of conversations around if we want to continue investing in blue states. With where the current regulatory environment is, we're actually pretty comfortable with it. You have both statewide regulatory guidances you have to follow, as well as local ordinances. And what's interesting is while we're a blue state, Eastern Washington is solidly red. And so we don't have much hostility from local councils or counties, but we do have the rent increase that the state legislation passed. And so there we can only increase it by 7% plus the consumer price index. So we budget about 9-10% annual increase max. And it's not too difficult it's very manageable if you know this while you're underwriting for the acquisition. Historically before this, we would just, when leases come up for renewal, mark up to market rates, and if they stay, cool. If they move out, we renovate. Now we have to model out more of steady progression of trying to raise current rents up to market rate. And that might take a few iterations of lease renewals, but we can model that out and factor for it. But the main impact there is that we are taking a little bit longer to fully stabilize the property. But it creates a little bit more predictability in our revenue forecasts.
So when you're doing that, do you change the renovation, the level of renovation per turn? Is that how kind of you do it? Or you're just doing, how does that kind of work? Or is it just really on your renewals with current tenants?
Yeah, we have a consistent improvement package we put in. And so we don't change the scope of the renewal because we know what the market rate is and we'll get there eventually. And what's nice is, once the property is vacant and we do the renovation, we can market it at market rents immediately, right? It's more of if we're 30% below, if a tenant is 30% below the market rate and we can only maximum increase it 10% a year, well, rationally, unless they have a different life event that causes them to move, they're going to stay there until their rent gets up to market rate and then they might move, right? So it'll take us maybe 3 iterations to get up there.
Okay. All right. Yeah. So that makes sense. If you had to change the renovation and like spend 2 turns on renovating a property to hit it, that would be a kind of a mess in the whole operations. But if you're able to do that once it's vacant, you can set it at market rent. So that makes sense. And you just have to, it's just kind of working with your current residents to increase as you can. But it becomes a little bit of a hurdle, I guess, when you're going into, like you said, a property that's 30% under market. And now you're little by little, you have to kind of work towards getting it up there.
We got bit on one unit on one property. We bought this apartment and the seller had a family friend living in one of the studio apartments. And he did work on the property in exchange for like $200 a month in rent. And his lease came up for renewal a month after this legislation passed. And we kept asking, what his plan was, but he dragged his feet until the legislation passed and we couldn't. So I think market rate's $700 or $800. So it'll take us, I think we forecasted that it'll take us like 15 years to catch up to market or something crazy like that. So that's the only one that really bit us.
Yeah. That's one of the things of having like superintendents at your property, let's just say loosely, because I've always found that being an issue. I don't know if you've ever utilized them, maybe with smaller deals or something like that, but I've never found that it worked. It's easier just to hire someone third party to come in and take care of it. I know it's going to be taken care of. I think there's more responsibility on having that done than a tenant doing it. I've kind of always tried to keep those separate, even all the times when I self-managed for many years, people trying to bring these deals or situations to me where this would work out great for everyone, they would say.
I think that's a real healthy viewpoint of it. Don't mix the different sides of the business. And if you have a contractor who's not doing good work, you can fire him, right? If you have a tenant who's not doing good work, you just get up in a bind.
Definitely. So kind of like over the last couple of years, like you were talking about, a lot of operators kind of have found themselves underwater and possibly in a situation where a property has fallen into disrepair because if they're not paying their debt, they might not be paying for what they should be paying and doing what they're supposed to do at a property. Have you purchased any properties from any distressed sellers where maybe you had to structure anything creatively or you had to change around maybe the initial kind of points of a deal to make it work with what the condition of the property was?
So let me answer that in 2 parts. One is, for the past couple of years, everyone's been expecting for this wave of distressed sellers to hit the market. We haven't seen that. And I talked to lenders. They all claim to have pretty clean balance sheets, which I don't believe everyone has perfect balance sheets. But I think that the anticipation of the rate drops has kind of helped everyone justify, extend, and pretend. I think also that it's just kind of slowly been working through. So we haven't seen much of that. We did have one of our more recent acquisitions. It was late last year. It was a seller, and these are the gems. These are the ones that you dream of, these types of deals. But the owner was a doctor lived in California. And he had 102 units in Pullman, Washington. Ironically, my wife and I actually lived in one of those apartments during undergrad. And then his property managers were out of Seattle and didn't keep eyes on this. So, deferred maintenance, poor management, they had some vacancies. And on the vacant units, they would just turn the heat off. Well, we had a deep freeze come through. And a number of the units that were vacant had the external walls, their piping freeze. And this guy, I mean, we budgeted after we found that out, 1.3 million in total improvements to go through on that. And he didn't have that money. So these have actually been sitting vacant for a couple of years. So we came in, we got huge seller concessions. My partner Max is currently in the middle of running crews up there to go through all this. And, but that's where you have to get really creative, because we had to work with a lender on that, where we got $850,000 in seller credits on a $6 million purchase price. And we needed that money to go in and invest it into improving these units, whereas the lender wants to deleverage the loan with that, right? And so we had to get quite creative in there to be able to get that cash to hit our bank account and put it to use and not get it tied up in deleveraging.
Wow, that's quite the deal. That's one thing. When was that property built? Do you know?
1997.
Really? So
reasonably new.
Yeah. It's interesting because in the Northeast, we'd find that with older properties with water, you know what I mean, running up the exterior walls. There's something that they changed really to more interior, you know what I mean? Kind of like running those pipes in there. So that's an interesting thing. You usually see that in something that was like 60s or before built from where I started investing.
Yeah, I was surprised that they designed the units for exterior plumbing. I mean, that seems like quite a big risk.
It's also risky to turn off your heat anywhere. I mean, that's just like, it's you don't have to keep it that hot, but man, like we've had that before with radiators. We've had that. I mean, it's just it's something that it's when you don't have present management that's not seeing that, you know what I mean? And it becomes a mess.
Yeah, you save $10 on electricity, but cost thousands of dollars in damage. So,
yeah. I remember years back when I had smaller multifamilies up in Connecticut, we would do like, I would text some of the tenants and be like, hey, you know, like let your like faucet drip and like leave this open, you know, all this stuff because when you have that, when it happens, I mean, it becomes like basements flooded. You got to call like water. I mean, it's just can be a mess for anybody that's had it done. So it was something that you'd always be like diligently checking weather and seeing what was going on with it. If you had any vacant units, and in small multis, even if you don't have vacancies, there's not a lot of water that's used. So there's not much water that's moving. You know what I mean? Versus if you had a 20 unit where someone's flushing the toilet every half hour, you know what I mean? So it's not really a problem per se.
If I could digress and tell a story here, and I think the lesson of this story is, Casey, don't be an idiot and hire people who are better at doing things than you are. But it was my first year or two into owning the duplexes, and you know, I was so scared of losing money that I was trying to do everything myself, from some of the repairs to managing the property. And it was December, and my tenant had just moved out, and the furnace had just broken down. And so I couldn't get a guy. This is on a Friday night. I couldn't get a guy out there till Monday. And we had a blizzard come through, and it's like 15 degrees out. And I'm just like, crap, what am I going to do here? Like, I don't want pipes to burst. And so in bed, and it's 2:30 a.m. And I'm just like, oh, turn on the faucets to let them drip, you idiot. And so I'm like, well, I can't go back to sleep now. I'm envisioning like all these pipes freezing. And so 2:30, I get in my car. There's a foot of brand new snow. It's snowing. It was actually very pretty. There's no one out. And so I go and I walk into the unit, and the carryover heat from the other side, it's like a balmy 55 degrees in there. I'm like, oh, okay, well, that was a pointless trip. But, you know, you can't go back to bed thinking that you're flooding your own property.
Jeez. Yeah. Isn't it like the heat from a different unit as well? It can come in and like heat up. I found it like before, people were telling me that it could heat up the pipes on the other side. I mean, it's just like, it's a whole mess. You have to keep the units kind of heated. And it's one of the things that, man, that's a mess. But furnaces, and I mean, think about if you had tenants there. I mean, my God, I mean, what you would be doing, it'd be like, it's a mess. So, but so how does your firm handle your property management now? Are you using third party where you go? Do you guys self-manage any of them, or do you have your own in-house property management for any part of your portfolio?
Yeah, we've had a lot of conversation around this. You know, right now with rebuilding the portfolio starting in 2023, we use third party management. We've talked about if we want to move into vertically integrate and bring that in-house. I think we're going to be hesitant to do that because we want to focus on our core competencies. And as long as we're finding property managers that we like working with and that keep their eye on the ball, the only reason we'd want to bring it in-house is if we think that we can optimize the performance more than what a third-party manager does. And as of now, I don't think that's the case. And we're not interested in trying to get new revenue streams or profit centers just to do that. So yeah. What about you?
No, I agree with that. When we use third-party management as well. I mean, I self-managed myself on some small properties many years back, like for 6 years, just a dozen or so units that I had myself before we were given a third party, and I was able to grow it much faster by doing that. And the second thing also was just like when people say profit center, it's a tough business. Everybody knows this, but it is a tight margin business. It's not like some other, people jump into it and I always think twice or think about it to myself, really, like, this is what you go into. You're going to bring on like this whole new staff, right? You know what I mean? You're going to like 5X your whole team by bringing these people on that you have to keep them happy, and you have to find more people for them. And I mean, finding handymen alone is like such a difficult job that like show up and do stuff, let alone now you have to put them on your payroll, make sure for all these different units. And the margin's very thin. I mean, I think it's like I don't know. There's a lot of other things I would take on my plate, like maybe purchase like an HVAC company or maybe a plumbing company first, because I see those checks that we stroke out for those. And you're like, whoa, is that my attorney? Nope, that's my plumber. And then it's just like, it's one of those things where you're like, I'd rather buy like a plumbing company with like 3 plumbers and then versus buying just a property management company where the margins are razor thin.
Yeah. You have the HR issues. You got to develop a whole new set. I mean, every business needs their own processes and protocols. And yeah, I'm not very motivated to get into that space.
Especially if you're going into a new market. Just one last thing is what I found is going into new markets, you're paying for not only people, I think new investors are like, oh, this guy's just picking up the phone and then he's just like calling like a contractor. And if you have my first property manager was like seasoned like 30 plus years in one market. And I mean, the connections that he had and who he could call, I could never have those, you know what I mean? And that was because of decades and decades of being there and everybody knowing his name and the respect he got. And that's why I found him as a referral through another landlord. But it's one of those things where that's what you're paying for too. You're paying for a little bit more of that, of like knowing it, and then also knowing the market about stuff that you're purchasing, much easier than going out and getting like 10 bids where like, this guy going to do it right? That's a very fair price. You should have him do the roof. It's much easier that way than, you know what I mean? And makes it easier to be an asset manager, also, / owner when you have that good manager, as I found.
Couldn't agree more.
So getting into multifamily, what are some of the mistakes you've seen over this decade plus journey you've had from house hacking small multifamily to getting into larger syndications and developments?
So the question was what mistakes I've seen?
Yeah, I would say common mistakes that you see multifamily investors make. And it could be anything you have here. It could be for active investors. It could be for passive investors. You could mix them together. Anything goes.
Oh, it's a long list. I think let's steer away from maybe other operators and GPs, but people wanting like just your general investors who might have $100K or want to kind of pool their money with some partners and get into a larger or mid-sized multifamily, not understanding the amount of time, relationships that it takes to get into this. And you'll see 2 types of investors when they're coming into or evaluating a syndication, right? It's either I don't got time for that. Casey knows best. I'm just going to work with Casey on his next deal. Or there's either they think it's sexy to get into, or they say I don't want to pay a syndication overhead fee. I want all the profit for myself, so I'm just going to do it myself. And that just gets into a whole can of worms there of, we get the best look at deals because of our experience within relationships. I think people are often better focused or better served by focusing their time on either improving their own career and income or spending it with family rather than, dealing with the burst pipes and the furnace issues that we talked about,
That makes perfect sense. Yeah.
We could also,
you go on.
Well, so we could also, it's been harped on probably quite a bit with other guests on your show, but people getting into the frenzy in 2020, 2021, early 2022, FOMO of missing out on a deal, overpaying, risky debt structures, bridge loans. That's all coming back to bite people. We were fortunate we didn't get too exposed on that. But yeah, I don't know what you've seen. I mean, you sold your portfolio in 2022, like early. I believe you said that's remarkable timing.
It was I had a property manager change at the end of 21, and that was just on my personal ones. Our syndication ones, we sold one in 2022, a syndicated property, one in 2023, and we have a few more now that we're working through, and we just refinanced one, so that are doing fine. But that was a personal one, and that was just lucky timing. I'm not gonna lie about that. It was just
take it.
Yeah, I'll take it where I can. But I mean, it's
Right.
it's difficult finding when you're working with people or talking to people, especially new potential investors, and they keep on getting into the fees and stuff like that. Not so much I've had recently, but like years back when we started raising money from investors, and they would really like spend like half the call on the fees. And you're like, you don't want to be like mean, but you just like know to yourself, like, this isn't going to like fly, because like all the different deals that you have to look at and like the amount of work and everything goes into it. I mean, we're just trying to keep the lights on, and then we sell and we can split that with you. You know what I mean? Kind of like with you taking the majority of it.
I think we've all had those same conversations. Yeah, I mean, we also have personal risk guarantees on the debt. I often pose the questions to my investors of, I hope that you want us to be, one, getting paid enough to stick around, because you don't want us to go out of business while we're in the process of managing an investment. And then alignment of incentives is really where the promote comes in,
Yeah. And that's where they're going to go. We've done it before, where we've like dipped into our funds to cover between getting lender funds, stuff like this. And like, you want to make sure that they're willing to do that because they see the payoff at the end too. You know what I mean? To have that incentive. And I think if you really just like take away a lot of the fees that like keep kind of the lights on, for lack of a better word, in the beginning, it's going to be more difficult for that GP to like see that, going through. But what would you say over the years have been kind of some of the factors contributing to your success?
Building partnerships where there's a lot of trust. I mean, I have my skill sets, and bringing in partners, like, for example, my partner Max, who handles the asset management. He came in with less experience into Tamarack, but I know he had a solid operational background, and he has committed himself to learning. We got him in a mastermind group to learn best practices on asset management. And now, I mean, the amount of time we're doing a new acquisition, I'm like, Max, what do you think about, these costs or this strategy, or what does lease up look, and then, outside partnerships too, like brokers and lenders that you can trust and rely on, and you have a rapport and a track record with when I first started in this, I started my first syndication. It was actually a fun. It was in 2020. I was a CFO of a law firm, and I gave my boss my notice in February of 2020. And of course, then the pandemic hit, and I helped them transition through with, like, if people remember the PPP loans and disaster recovery loans. We got all that, worked on just getting the entire office and team transitioned to remote. But then, I transitioned out in July of 2020, and talk about feeling the complete lack of partnerships and not knowing how to develop relationships when we're all sitting at home. It was a really stressful and lonely time in there. So over the past 5 years, then building out the relationships has really just, with your investors, it doesn't happen without a team.
Well, Casey, thank you so much for coming on. How can our listeners learn more about you and your business?
Yeah, we're Tamarack Capital. Our website is tamarackrei.com. I'm on LinkedIn. Just search for Casey Stratton. You should be able to find me. We have a newsletter to kind of talk about what we're seeing on the market, how deals are going, and then new investment opportunities. So if you're listeners are interested in that, go to our website and sign up on it. And I'm always happy to jump on a call and chat investments. And one of my favorite parts about this job, with me being the investor relations focus guy, is talking with people from so many different backgrounds, hearing what their financial goals are, and seeing if we're a fit for that. It's just this really enjoyable.
Casey, thank you so much for coming on today. We'll put those links into the show notes, and looking forward to connecting with you here in the near future.
Thank you so much for having me. This was fun.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.